This weekly news flash is sponsored by Financial Independence Group. Our products are strong, but our strength is in our people. For more information, please visit joinfig.com. A federal judge in Virginia on Tuesday dismissed a lawsuit attempting to strike down the health care law set forth by President Obama. U.S. District Judge Norman Moon ruled the law requiring individuals to purchase health insurance coverage and employers to buy coverage for their employees was legal under the Commerce Clause of the U.S. Constitution. Christian Liberty University, the organization that filed the suit, argued that the law violates the Constitution. According to Judge Moon, if the coverage requirement wasn't in place, the cost of health insurance would rise as the number of insured Americans declined. He notes the regulatory measures are intended to prevent such a scenario. He also ruled that the employer coverage provision is a lawful exercise of Congress, since interstate commerce would be adversely affected if larger companies did not offer sufficient health care coverage. The suit is one of approximately 20 challenges to the law currently in federal court. Rulings on the other suits are expected in coming months. The majority of the suits focus on the Commerce Clause and whether the federal government can regulate Americans' decisions to purchase a good or service. The government characterizes potential fines as penalties rather than taxes, but critics argue they are punitive fines, which the government does not have the authority to impose. Judge Moon ruled the fines are penalties and says they are not intended to raise revenues. Rather, he says they are meant to enforce the requirement that individuals and employers purchase or provide health insurance. This is the second major rule supporting the law. A Michigan judge last month upheld provisions requiring Americans to purchase health insurance. American International Group sold $2 billion in bonds on Tuesday in its first bond offering since the financial crisis in 2008. AIG issued $500 million in three-year notes at a 3.65% rate and $1.5 billion in 10-year notes at a 6.4% rate. The notes were rated A3 by Moody's Investors Service. AIG says the proceeds will be used for general corporate purposes. The insurer also closed a deal to sell 80% of its consumer finance business with Fortress Investment Group on Tuesday. Both transactions are part of AIG's plan to repay the government for bailout money received during the crisis and to regain its independence. A report released by the American Association for Long-Term Care Insurance says 1/4 of long-term care insurance buyers who are age 60 and under pay less than $1,000 per year for their coverage. The report looked at LTC insurance purchasers from the first half of 2009. Nearly 29% of LTC policyholders under age 61 pay between $1,500 and $2,500 per year in premiums. Less than 1/10 of LTC buyers in this age group pay $4,000 or more. Costs for LTC coverage can vary widely and depend on a number of factors, including age and health status. The average age for new individuals purchasing new LTC policies is 57. 80.5% of new individual buyers in 2009 were under age 65. A recent LIMRA survey found that women purchase 6 out of every 10 immediate annuity contracts. The Guaranteed Income Annuities Report looked at more than 55,000 immediate annuity contracts written between 2008 and 2009. The report says that the average age at purchase of an immediate annuity was 73. The average immediate annuity premium was $107,000. And 7 in 10 of those immediate annuity buyers bought a lifetime guaranteed income contract. LIMRA says the majority of immediate annuities are sold by insurance agents, but more banks and broker-dealers are selling immediate annuities. For more on the industry, visit producersweb.com.